When you watch professionals sharing their opinions on the economy and the stock market, it feels such clarity in their thinking. You're willing to follow them on Twitter, you pay attention whenever they're on camera. How did they build such clarity in thinking about the economy and the market? Is there a common framework we can go back to time and time again whenever new information comes in? In this video, we'll try to investigate from a professional view what's the framework of investing, how to analyze information, the process of selecting stocks. By the end of this video, you probably won't be able to predict who the next Apple is, but hopefully it helps you build some clarity to think about investing. When it comes to equity investment, we know there are two types of analysis, technical and fundamental. Sometimes you see on TV, in blog posts, or YouTube videos that someone is analyzing stocks. They will point to a chart and say, there's a double top, we have a morning star, or that's a three-line strike. Signals chance to get in. Technical analysis in essence is to look for patterns. It analyzes historical information of a stock, such as price, volume, or volatility, and use this information to predict future price movement. Personally, I don't recommend relying too much on technical analysis, because what you may not realize is there are thousands of hedge funds and trading companies out there. Typically, they hire a lot of PhDs from math, physics, or computer science. These people's job is to build models and look for patterns. They could use fancy machine learning algorithms such as Iceberg, Ninja to analyze price or volume in the market. Whenever there's a tiny imbalance in the market, the computer's signal is triggered and their money swoops in to fill in the gap. Perhaps at the time you're still looking at the double top, 2,000 kilometers away. So as a retail investor, most likely the pattern you're looking at is already priced in. Price in the short term is decided by supply and demand. In the long term, it's decided by value. If your investment horizon is months or years, technical analysis can be very risky. It's more suitable for short-term investing. So as a retail investor, perhaps it's better to focus on the long term, which uses fundamental analysis. Fundamental analysis has three levels: macro, industry, and the company. Let's talk about the macro first. Some people don't care about macro, they think it's boring and too many theories, has nothing to do with stock prices. So do we need to care about macro? Absolutely yes. Let's look at this chart. The blue line is the total asset on US Central Bank's balance sheet. Think of it as the amount of money the central bank injects into the economy. The white line is price movement of the US stock market. We can see from 2008 to 2021, the 12 years of bull market rised and fell pretty much in tandem with the Fed's balance sheet. What does it mean? It means when there's too much money out there, prices rise. It's like when you live in a town where there is sustained inflow of rich people, prices in the neighborhood will continue to rise. No matter where we look at, the People's Bank of China, China's central bank, or the Fed, US central bank, there are various policies such as quantitative easing, lowering target interest rate or reserve ratio. Their intention is to control how much money stays in the economy. The 12 years of bull market has a lot to do with first, quantitative easing, second, tax reduction, and third, sluggish growth in other parts of the world, which drives a lot of money inflows into the US. Another example is 2017. China began deleveraging, reducing the amount of money in the economy. In 2018, Chinese bear market lasted for an entire year. We also saw various kinds of private companies had liquidity problems and went bankrupt. As you can see, macro is very important. If you're going to take a finance course on how to construct your portfolio, the first step is not to analyze stocks, but asset allocation. It means you need to decide which countries to invest, developed or emerging, which asset class, stock or bond. Then the second step is security selection, which includes picking stocks. This is a video made by Dalio who talks about how the economic machine works on a macro level. It's simple to understand with great animations. If you haven't watched this video, I highly recommend you watch it after finishing this video. So back to where we were, there are many macro indicators we can look at, such as GDP, CPI, unemployment rate, PMI. They measure the current and future conditions of the economy. Let's say now you look at the macro, you did your analysis. How do you invest based on your analysis? The simplest way is through ETFs and mutual funds. They invest in different countries, different asset classes. When you buy one, it automatically buys a basket of stocks and bonds, which gives you built-in diversification. This is the macro. If we go into a level deeper, we come into the industry. Generally speaking, if an industry is performing well, performance of the companies in the industry shouldn't be so bad, since the stocks in one industry usually have high correlations. But sometimes the difference across industries can be very substantial. For example, in 2020, technology sector has increased 40% while energy sector declined by 30%. Personally, I feel for retail investing, picking the right industry is more important than picking the right stock. Because there are thousands of companies to choose from, as an individual investor, it's difficult to get to know every company in detail. But when it comes to industry, more or less you know something about it. If you pick the right one, it's much easier to pick a winning stock than to pick a stock from a declining industry. To analyze industry, we need to look at 4 places. First one is cycles, whether the industry is growing, maturing, or declining. Second one is the dynamics of the industry, how it performs in different phases of the business cycle, whether it has high barrier of entry, such as finance or tobacco, or it has low barrier of entry, in which we'll have more competitions. If barrier of entry is higher, then profit margin will be relatively higher. Third one is government policy. This is the critical one and could potentially have a big impact on the industry and prices. For example, in 2015, Chinese government issued a policy to reform the supply side capacity in the energy sector. Company on the upstream reduced the quantities of their output, which drives prices up, increasing the profit margin. So in 2016 and 2017, prices of steel and coal in China were performing very well. The last one I would say is a little bit subjective. It's called sector rotation. Essentially, it's the bias in the market, which type of stocks people likes to buy at a particular moment. For example, growth stock, technology stock, small cap stocks. For retail investors, if you don't want to spend a lot of time looking at companies, your analysis can stop at the industry level. The simplest way to invest is through ETF, such as industry ETFs, the iShare ones from BlackRock, or the Spider ETFs from State Street. But for some of us, investing in index funds sounds boring. They like to go a step further and pick their own stocks, which brings us to company analysis. To evaluate a company's business, the main point is to look at the company's ability to generate future profits or expected cash flow. To analyze a company, we either go qualitative or quantitative. Qualitative analysis are things like business model, growth, and economic moat. Now that we're moving everything online, a company can have numerous economic moats. For example, for online platforms, users are their moat. Capital is another big one. When Amazon saw an e-commerce business specializing in reviewing and selling maternity products, if Amazon wants to compete with it, it can go into a price war by selling the same products a little bit cheaper. Because Amazon has huge amount of capital, it can provide subsidies to draw customers to buy on Amazon. Eventually, Amazon negotiates a deal with a company and do an acquisition. Of course, when government wants to stimulate the competition in the economy, it will set up policies to fight against monopolies. If you'd like to know more about economic moat and how Warren Buffett used this strategy throughout his investing career, you can check out the little book that builds wealth by Pat Dorsey, which I will leave a link in the description. Speaking of Warren Buffett, one of the crucial factors in qualitative analysis is the company's management. Sometimes you can't just look at the company's financial data and business model. Management is very important. For example, we'll never know to what percentage Tesla's stock price is based on people's beliefs in Elon Musk, but certainly that's a factor there. Or when the founder of Lululemon, Chip Wilson, declared that not every woman could wear the company's famous pants, Lululemon's stock price dropped by 18% in one single day. You probably heard that prior to Warren Buffett invested in Disney and Wells Fargo, he had dinner with the company's management. When he feels right about the people, he buys. So qualitative to a large extent is how you tell the story. But when everybody believes a story, stock price could already be very high. Then a good company becomes a bad investment. Except for listening stories, we'd better look at how the company was doing in the past, which brings us to quantitative analysis. You can start with the three tables: income statement, balance sheet, and cash flow statement. Looking at these financial statements is about looking at some key indicators through the company's history. The most common ones such as PE ratio, profit margin. The things to keep in mind here is that for different industries, the things you're looking at could be very different. For example, in retail industry, cash flow is very important, but for real estate, because it's capital intensive, you will see a lot of receivables and payables, so things like accounts receivable becomes much more important. If we switch to the healthcare industry, for example in hospital, how much money hospital makes depends on how many beds they have to receive patients. So a typical ratio we use is to divide the enterprise value by the number of beds. All in all, the things to focus on could be very different across industries. Analyzing the company could get very time-consuming and tedious, so I would still recommend for most retail investors, focusing on the macro and industry level is more important than picking the right stocks. To recap, we've looked at the professional framework of stock market investing, what's involved in each level, the macro, the industry, and the companies, and how you analyze each segment and invest based on your analysis. Of course, this is a broad overview of the framework of investing. If you dig into each part, there can be many details to explore. If you guys like more videos like this, please leave a comment below letting me know which part would you like to know more so we can investigate it together. Thank you guys for sticking to the end. Please don't hesitate to give me a thumbs up. I sincerely appreciate it, and don't forget to subscribe to the channel for more in-depth content of economics and investing. And last but not least, best wishes to you, my friend. I'll see you soon.